One of the hardest lessons I've learned while trading in the stock market is that timing the market is a fool's game. And 60% of the times, it will cost you money every time. What is up, Bubs? Thank you for tuning in and welcome to the basic concept. Now, we are approaching that 1,000 subscriber mark, so I want to thank you for all the recent support and engagement that you guys have brought in. And hopefully we can continue growing the channel together and I can continue to inspire more people to have better financial footing. And today, I want to talk about timing the market versus time in the market. Now, timing the market is when you're trying to get like the best time to buy your stocks or funds. So buying the lowest of the lows and keeping it until it goes high and then turning it in for a profit. The lows usually happen with something that's going on with the market. Like it could be a market correction, which usually deviates the market 5 to 10% down. Or it could be like something that's affecting the global sector, which would be like World War III, the recent coronavirus outbreak, and pretty much anything like that that could have a serious effect on the market. Now, typically that's hard to predict because you never know when the bottom is going to be. It could be today, it could have been yesterday, it could be tomorrow. There's really no way to tell unless you have a crystal ball. Let's take a look at a chart of S&P 500 around 2008 crash. Now, if this was real time, how would you identify when this hit bottom? The fact is that there's no way to know what the market will do tomorrow. It could hit even lower lows and you still didn't time it perfectly, or it could start bouncing back and you have now missed the opportunity of buying lows. Time in the market basically means investing as early as you can and as often as you can. But not really. You can still be smart about it and still have time in the market. Basically what I mean is, when your portfolio is diversified, there's going to be funds that are doing better than the others at any given moment. So when you're ready to invest, choose wisely and invest in the funds that is on the downtrend or maybe a better buy at that moment. And not waiting till one turns up or turns down. Basically buying as soon as you have the money and then just put it in the fund depending on which one is the best option at that given moment. But generally speaking, time in the market is usually going to pay off over time. Now, obviously this is for long-term investing. Short-term investing, there's other methods to make money. But if you know my channel and know me, we are all about long-term investing and making sure our future are secured and trying to get that generational wealth. Timing the market is something super popular because people want to believe in the getting rich quick schemes and trying to get filthy rich overnight by just having the perfect timing in the market. But nobody has done that. Nobody's done that so far, and I don't think anybody can do that effectively. Think about it. You would have to time the market perfectly twice, not just once. Once when it's on the downtrend, so you're buying it at the lowest of the low. And then a second time when the market is at its peak is when you're going to be selling. And you'd have to repeat that trade over and over because most people are going to be starting with $1,000 to $10,000. So $10,000, even if you're doubling it on every single trade, you're going to have to do it a lot of times to get to that $1 million mark or more. Here are some stats to back up what I'm trying to tell you. Since 1926, the stock market has not had a single 20-year span where the market lost you money. Basically, if you invested money for a long term, which would be 10 to 15 years or even 5 years, there's a very small chance of you losing money. Since 1950, there's been one 5-year term where you would have lost money, and it was about 3%. But think about it this way: 3% is barely above inflation rate. So if you just held on to your cash instead of investing your money, you would have lost the money anyways. On the plus side of it, if you did invest in one of the best 5-year terms, that would have turned you a 28% increase in your money. So I know a lot of you are going to be like, well, that's 1926 and 1950, that's old stuff, like who cares, right? So let's take a look at a more recent example of a stock market crash, like the 2008 one. So in 2008, the stock market was peaked at around $1,500 per share for the S&P 500 fund. In the following year, it dropped down as much as 38%, all the way down to $1,000 per share. So let's say that you started investing right before the crash and you bought the stock at the peak of $1,500 per share. The immediate loss at that point would have been about 38%. You would have dropped it down to about $1,000 per share. But since we're doing long-term investing, you would have kept it for at least 5 years. So in 5 years, that would have been 2014. The stock market, or I'm sorry, the S&P 500 specifically was trading back at $2,100. So essentially a 35% gain from where you invested in. So yeah, you would have lost paper value right at the crash, and it feels bad, but in long term, you actually made up 35% of your money. So your $1,000 or $10,000 or $1,000, whatever you invested, would have been either $1,500 or $15,000, depending on how much you put in. And let's say if you continue that for a little bit longer of a term, so for a 10-year term, in 2018, on December 31st, the stock market closed at $2,500 per share. So now we went from $1,500 to $2,500, a much substantial gain compared to inflation would have cost you about, again, 2 to 3% of buying power regardless. So there's really no downside of leaving your money in the market for long term. As humans, it's super easy to get caught up in the hype. The problem with hype is that it's usually pretty late, because that's when people are trying to sell their shares. They know that there's a ton of buyers wanting to buy the shares, and it's easy for them to process the order and get their money out as quickly as possible. Now, can you believe that they're bigger nerds than I am? Well, they are. These nerds have published papers about this type of phenomena. Basically, what they're stating is that timing the market is just a bad idea all along. These papers go into great detail about what happens when you try to time the market versus what happens if you just put in money as soon as possible, and what happens if you pick the worst days possible for buying and selling. I don't want to bore you with their full case studies of what actually happens and all the data behind it, but to summarize, what they've said is that if you timed the market perfectly, your results would have been 10 to 15% higher than if you just put money on the first of every month or the first of every year. Basically, you're doing a lot more work, trying to research a lot more, but only coming up maybe 10 to 15% higher than somebody that's just putting in money every single month or every single year at the exact same time, no matter what the market is doing. Now, 10 to 15% is actually a pretty good deal, because this is over 30 years of time, so your entire lifetime of investing, and you're coming up 15%, which is actually really good. But you're trading perfectly. That means you're not missing any trades. You're basically buying at the lowest lows and selling at the highest highs without missing a beat. Now, in the same study, or maybe the similar study, they showed that if the person that's trying to time the market just missed 10 of the perfect trading days, their results would have been almost identical, if not worse, than the person that was just putting in their money on the first of every month or the first of every year. In the same study, they showed that even if you had the worst luck and you were buying the stock at the worst time possible, the results were still surprisingly good, comparatively speaking, to leaving your money in a savings account or even trading without trying to time the market. So one more time, to summarize this summary, basically for long-term investing, timing the market is just a fool's game and honestly just a waste of time. In my early trading days, I did fall into some of those traps myself. I'm not going to bore you with all the losses that I've accrued because of me trying to time the market, but the lessons that I've learned are these. Everyone that you meet, whether it's online or in person, they all have their own agenda, and following somebody's advice blindly is just going to lead you into a bad time no matter what you do. Instead of listening to somebody else's advice, what you should do is investigate the funds that you want to invest in, whether stocks, ETFs, bonds, mutual funds, whatever it is. And then when you're ready to invest in, at that time, find the best value that you can add on to your portfolio. After that, let your best friend named compound interest take over and take the wheel and drive you to the generational wealth that you're after. Let me know what you think of this video in the comment section below, and tell me if it was helpful. Also, let me know where you plan to invest or where you're currently investing. Don't forget to like and especially subscribe so I can keep bringing info about personal finance and money to y'all. As always, thank you for watching. We'll see you next time.